Okay, I'm gonna show you some magic now. It's gonna blow your mind. It's called depreciation. How do we actually make money through something called depreciation, which is a paper expense? This is so confusing for folks, but I'm gonna break it down for you so simple today that is literally gonna blow your mind, and you're gonna ask yourself, why is not everyone investing in real estate for literally this one benefit alone? So let's talk about what is depreciation really quick. So the IRS says that you can depreciate real estate over a period of 27.5 years. Quickly, let me just go back and use an example. Let's say you have an iPhone, right? And this iPhone over time is going to decrease in value. You can see mine, it's cracked and whatnot. And so clearly the value of this iPhone is going down. The same thing happens in real estate to the building, right? That you have a building and the structure of that building is decreasing or depreciating in value over time. And the IRS says that's 27.5 years for residential real estate. So let's say, for example, we're gonna use $1 million asset, right? And what you do in order to depreciate that building, you say $1 million, and I'm gonna pull out my calculator here so you can see this. So let's just say we have $1 million asset, okay? 1 million. All right, you got a $1 million asset, 27.5 years. 27.5 years. So this thing's gonna depreciate. So 1 million divided by 27.5 is 36,000. Let's just call it roughly 36,000 in depreciation, okay? So that means every year on your what we call a K1 statement, is what you get at the end of the year, you're able to deduct $36,000. And what you can use that depreciation against is the income of the property. So let's say on $1 million property, to be conservative, we make 75,000 bucks. We're gonna use less than 1%, so $75,000 in gross rental income, okay? So we're making from this $1 million, we're gonna make $75,000 in income. We can use this against whatever the income is, but I wanna show you the power of depreciation. So if you're in the highest income bracket, let's call it, because rental income, let's say you're taxed at 37%. You're in the highest income bracket because you're a high income earner. If you make $75,000 in rental income and you're taxed at this, you're gonna be taxed, let's see, 75,000 times 0.37. You're gonna have to pay the government, Uncle Sam, $27,750 in taxes, okay? It's at 37, the highest tax bracket. But because of depreciation, which again is just a line item of what the IRS allows us to do as real estate investors and take advantage of this, we can take the 75K and deduct it from our depreciations. And watch how this change, like literally can keep more money in your pocket. This is how you build wealth through real estate. You take the 75,000, you deduct your depreciation, so $36,000. We're now at 39,000. Again, 37% here. We take 39 now. We times it by 37%. And what we get is 14,430. The difference of 27,750 minus 14,430 is $13,320. Literally over 10K solely because we got to use depreciation. Literally, you just kept $13,000 in your pocket. Wouldn't that help? Wouldn't that be nice to have an extra $13,000? Now imagine doing this on a much larger scale. $10 million property, $100 million property. Right? The amount of money we can save through depreciation.